And joining me now to talk more about China, Mikio Kumada, a global market strategist at LGT Capital Management. Good morning, sir. Good morning, Mikio. Thanks very much for joining us.
Good morning. Thanks
All the
for having
talk
me.
over the last few days has been when China's going to raise interest rates and possibly increase the bank reserve ratio requirements. What do you think?
Yes. Well, I think China is between a rock and a hard place, and some of your reports already suggested that the complications of this tightening process in China, on the one hand, they have to, if they tighten too much, they risk crashing the domestic economies, at least a part of the domestic economy. If they tighten too little, they risk, having this bubble, credit-driven bubble grow even more, or maybe it's not yet a bubble but become a bubble, in which case they risk an even bigger crash later. So China and actually emerging Asia has been underperforming in terms of equity markets for a while now, and we don't see that picture changing anytime soon, meaning the next several months or maybe even a couple of quarters.
Well, what will it take
then
to change that? What will it take to change the fortunes of markets in the region?
Well, I think they can't really do much to change that. This is a process that they have to go through. Overall, I think they are doing a relatively good job, given the sensitivity of global financial markets to anything that goes on in China. I mean, they are just underperforming. They're not crashing. I'm talking about financial markets. So they are having this under control relatively well. And I think we will, as investors, you just need patience and some confidence in the global picture, which is actually improving, that will allow the Chinese economy and also the financial market difficulties and challenges they have at the moment to muddle through. I think that's the most likely scenario. But of course, you have to keep a watchful eye on it.
Where should we be putting our money then, Mikio? Because, as you say, taking into account all the evidence, I mean, you are still cautious. So what's our strategy going forward in the short to medium term?
Well, when I say cautious, we're actually cautious on a specific region, which is emerging Asia, and that's specifically related to the China issue we discussed. So, for example, in our global allocation, we are underweight that region and also emerging market as a whole. We're not negative because we still have a neutral weighting. We're just more positive on the U.S. in particular, but more generally on developed markets, because there the economies are actually, in relative terms at least, in a sweet spot. They don't really have major challenges in terms of policy. They just have to make sure that they don't make any major mistakes. We have the FOMC this week. They need to keep a steady hand, not to rock the boats. And all indicators suggest, including market-based, price-based indicators, that the recovery there from a low level, from a depressed level, is still, in the course of improving. So that's where we're putting our money. In developed markets, most notably in the U.S., you also get higher dividends, and you actually don't need a lot of growth in these markets. It's true, for example, that Europe has low growth, but Europe doesn't need a lot of growth to produce decent returns in terms of earnings and in terms of dividends. So for the time being, we're quite happy there.
Mikio, thanks so much for joining us today.